living by one simple economic rule. Money was cheap. Interest rates in the US, the UK, Europe, they were all basically stuck at zero. And you know what? That one simple fact shaped everything. How we borrowed, how we invested, and even how we thought about risk. Well, that era, it's officially over. And that really brings us to the big question for this whole explainer. I mean, what if the fundamental rules of money, the ones we all got so used to for a decade, just got completely rewritten? Because, well, they have. And if you think nothing has really changed, you might be playing by a rulebook that's already out of date. Let's just be blunt here. For a really long time, borrowing money was almost free. Now it has a real, tangible cost. And this isn't just some small tweak, you guys. This is a massive shift, like a crack running right through the economic landscape we thought we knew. So to really get where we are now, we've got to look back at the world we just left behind. We can call it the era of cheap money, and it was a time defined by one single thing, those interest rates that were hovering right around zero. Okay, let's break this down. These super low rates had three huge knock-on effects. First, pretty obvious, they made borrowing incredibly cheap for literally everyone, from a family buying a house to the biggest corporations on the planet. Second, since safe investments like a savings account paid you like nothing, investors had to push out into riskier assets just to find a decent return. And third, all that cheap money chasing those returns just inflated the prices of, well, pretty much everything. Just look at real estate. When mortgage rates hit historic lows, way more people could suddenly afford to buy a home, and they could bid those prices higher and higher. All that demand, fueled almost entirely by cheap debt, sent property values through the roof. And it was the exact same story playing out in the stock market. Companies could borrow cheaply to grow their business, and investors who were just desperate for any kind of return flooded into stocks, pushing the whole market up to record highs. This environment was an absolute paradise for startups. Venture capital was like an open tap. I mean, it felt like any company with a big idea, didn't even matter if it was profitable, could get funded. The entire game was about betting on massive future growth. And this really gets to the core psychology of that entire era. When money is basically free and asset prices only seem to go up, taking on huge amounts of risk doesn't feel risky at all. In fact, it feels like the only logical thing to do. And then everything changed. Inflation, this dragon that everyone thought was asleep, came roaring back. And to fight it, central banks had no choice but to hit the economic reset button, using their most powerful weapon, jacking up interest rates. And the really wild thing is just how fast this all happened. We didn't gradually ease off the gas pedal. No, we went from 0 to 60 in a heartbeat. The cheap money spigot wasn't just tightened, it was slam shut, almost overnight. And this is where it gets real for millions and millions of people. Just think about a mortgage, right? At a 3% rate, you've got one monthly payment. But what happens to the exact same loan at 7%? That payment can literally more than double. That right there is the real-world impact of this economic reset. This quote just captures the shift perfectly. For a decade, debt was so cheap it was almost an afterthought on a balance sheet. It was kind of invisible. Not anymore. Now, every single dollar of debt carries a real significant cost. It demands your attention. So this big reset didn't affect everyone the same way. Not at all. It created a really clear divide, basically repricing the entire economic world and creating a whole new set of winners and losers. Okay, so let's look at this new landscape. Who gets hurt? Well, as you probably expect, it's anyone with a lot of debt, whether that's a family or a big company. The cost to pay back that debt just exploded. Growth stocks also took a big hit. But who benefits? For the first time in forever, savers do. And so do bond investors and pretty much anyone just holding cash. Suddenly being safe and liquid has real value again. For the first time in over a decade, you can put your money into something safe, like a savings account or a short-term bond, and actually earn a real, meaningful return. That old mantra, cash is trash, it's dead. Today, cash is an asset that actually pays you. This brings us to our final and maybe the most important section, because the biggest change here isn't just about the numbers on a spreadsheet. It's psychological. It's a fundamental shift in how we all have to think about money. This quote right here says it all. In the old era, money was chasing these big, futuristic dreams. Now, it's way more practical. It's looking for real, tangible returns that it can get today. It's chasing yield. So what's the new mindset? Well, it's basically the polar opposite of the old one. Patience now beats frantic activity. Holding cash is a smart strategy. Using too much leverage, too much debt, is just plain dangerous. And discipline is way, way more valuable than hype. The era of buy everything, no matter the price, is over. So here's the bottom line. The new playbook rewards the fundamentals. We are in a cycle that favors companies with real cash flow, strong balance sheets, and a solid plan for managing risk. The wild, speculative bets are out, boring old stability is in. And we'll end on this one thought. For over a decade, the biggest rewards often went to the people who were the most aggressive, the ones taking on the most debt and the most risk. But that game is over. In today's world of expensive money, the rewards are going to go to those who are intelligent, disciplined, and strategic. The rules have changed.